The market is crashing again. Investors are panicking, portfolios are bleeding red, and fear is spreading like wildfire. But before you hit that sell button right now, stop, because the worst decision you could make right now is acting emotionally. In this video, I'm going to attempt to give you the rule book for surviving and even coming out ahead in all of this chaos everyone is going through right now. We're going to get a playbook that is going to show proven strategies for surviving and coming out of ahead of all this chaos and turmoil right now in the market. Red everywhere, stocks are tanking, fear is at an all-time high. But let me tell you something, this is where fortunes are made. A market crash feels like the end of the world, but history tells us otherwise. Every single crash, yes, every single one has eventually recovered. That being said, only the smart investors who have stayed calm and used the right strategies have come out on top. So let's break it down. Step 1 is going to be risk control. Don't go all in and don't go all out. The biggest mistake is, like I said, letting emotions cloud your judgment. This is not the time to go all in on risky plays, nor is it the time to be afraid and sell all your positions when you're already down 20-30%. What a smart investor does is they manage their risk the best they can. Here are a couple ways you could do that. Don't invest money you need in the short term for things like food, rent, or any other things, car payments to drive around. Save that money for what you need in the short term. Diversify your portfolio. If you're all in tech, if you're all in AI, if you're all in crypto, maybe consider getting into some other value stocks right now, like Walmart, Coca-Cola even, things that have been around forever, blue chip stocks. And if you do use stop losses, which can be very good for cutting losses, don't make them too tight. You don't want to get sold out on a stop loss and then have the stock run away from you right after. The second powerful step you can do is called dollar cost averaging. No one's able to guess when a stock can actually hit the bottom. This is why many experienced investors, and beginners for that matter, use DCA, or dollar cost averaging, as a very useful tactic for building positions, especially in downtrending markets. The way you do this is you buy at regular intervals, even if the stock is up or down. This could look something like $100 a week or $100 a month, so long as it's consistent and you're buying no matter what level price is at. The reason why this is so useful is because when stocks are volatilely swinging up and higher and lower, going up 20%, going down 30%, you're going to average yourself somewhere in the middle using time to your advantage and consist. There's a term called catching the falling knife. This is where you see a giant red candle. You're like, oh, it can't go down anymore, so you try and catch it. Well, what happens if you catch a falling knife? You're obviously going to cut your hand and be bleeding even more in your portfolio. Dollar cost averaging prevents this because you're going to have more ammo to buy more as it's falling down. You're not chasing. Step 3. Don't panic sell. That's the worst thing you could do in this particular situation. The market has always historically recovered, and panic selling will lock in your losses and completely take you away from the prospect of recovering. 2008, everyone dumped their stocks, but in 5.5 years, the market had recovered and presumed to higher highs. Had you just hold, you would have been okay. In 2020, the S&P 500 crashed 34%, bottoming out. But if you had just held 5 months in that instance, you would have been okay and gone to higher highs once again. 2008 was a long and painful recovery due to the housing market crisis and a deep recession. COVID was the fastest financial recovery that we had in history due to the stimulus that was given out. This does prove that not all market crashes will be the same way because there are external factors at play, but in both instances, the best play was to stay in the market and not panic. Here's the truth. The market rewards being calm and patient and analytical and not being emotional and panic selling. In fact, Warren Buffett has a famous quote saying the stock market is a device for transferring money from the impatient to the patient. If you have a solid plan, you have solid stocks you already did due diligence on and like, or you're in safe ETFs like the VOO or the SPY or what have you, now's the time to be thinking about setting yourself up for a rebound. You don't want to be panicking. A year from now, when your investments have all reached all-time highs and you did this all the right way, that's what winning is going to look like for you. Just to recap quickly, we have risk control. Don't go all in. Stay diversified. We have dollar cost averaging to buy at regular intervals right now and take advantage of these sweet low prices. And we're not going to panic sell. Remember, the market rewards those who are patient with money and income. If you found this video helpful or interesting, please like and subscribe. Drop a comment below. Let me know how you're doing in this downturn and what your strategies are with the stocks that you're holding. Thanks for watching.